This is a very general overview of managerial accounting. You need to remember the information from this course for the advanced managerial accounting. There are also techniques that are not going to be discussed in this review, but if you need information on how to do them so you can remember what you learned in managerial, please let me know. Starting very simply with what do we mean by a cost? A cost is just the sacrifice of resources that we've made to achieve a particular purpose. Not necessarily a goal, because we may not achieve that goal, but it's a use of resources for a particular purpose. We need to understand our costs because of many different management functions. And at this point in your education, you should know these just by your gut instinct. So I'm not planning on asking you to list them, but you need to remember that there are many different costs for many different purposes. Some costs are appropriate for one use but not another. For example, a cost used to determine inventory valuation is irrelevant in deciding whether or not to manufacture a different product. But you just need to keep these in mind because these are the decisions we're going to be making. You know that an expense is defined as the cost that's incurred when an asset is used or sold for the purpose of generating revenue. You also need to remember the difference between period cost and product costs. Period costs are those that are non-product costs in an organization, like selling and administrative costs. They are not costs of inventory, so they do not go into the value of the inventory. Instead, they're expensed as time goes on. Product costs are the costs manufactured or the cost of the goods purchased for resale. These costs are inventoried and they remain in inventory until the item is sold, at which point they become cost of goods sold. You can tell what kind of company exists by looking at their balance sheet. A merchandising organization will have merchandise inventory, while the manufacturer will have several different inventory types: raw materials, work in process, and finished goods. The raw materials stay in storage. They wait there until they are needed in the work in process. They leave the storage room and go into production. Once they leave the storage room, they are considered work in process. And this could be anywhere from waiting to be cut or modified, whatever the process is. So I put in there that they're 0.001%. They are just there right out of the storage room all the way until they're almost completely finished and just need the last staple to hold their package together. So they could be anywhere from 0.001 to 99.99%. They are still in process. They're considered partially completed production items. Finished goods inventory arrives from the work in process inventory as soon as it's completed, and it stays that way until it is sold. Once it is sold, it comes out of inventory and goes into the cost of goods sold. There are various types of production processes. Now, it just happens that I was the lead author on a managerial accounting textbook. It's going to be online for free, but it's not finished yet. And I hope you can relate to the examples that I used and I'm going to give you here. The first type is a job shop. This is low production volume, little standardization. It's a one-of-a-kind product. So, for example, my daughter recently graduated college and refinished her dining room table. People asked her to do some refinishing for her, and she needs to cost out how much it would cost and what price she can charge in order to make it an acceptable deal for both of them. This is a custom thing, and it's done in a job shop. The second type of product is a batch. This is multiple products, but it's low volume. And think about a billboard. What about a billboard for a restaurant that's near Lincoln Field? You might have a couple billboards, but the volume's going to be very low. Next, think about your traditional assembly line. This is a few major products with a higher volume. So drumsticks are done in an assembly line, but there's differences in each drumstick in both the style and happens to be within each wooden stick. And finally, there's continuous flow. They're high volume, highly standardized commodity products. I happen to have two identical twin grandsons, and so my example is having them owning a cookie manufacturing plant. The products are identical, and each one looks the same. You don't know which batch differs from which other batch. Whenever you're working on an accounting problem, especially involving managerial accounting, you need to remember that a product consists of three components. We've got the direct materials, the direct labor, and the manufacturing overhead. All three of these combine to become the finished product. Sometimes the components are so obvious to us that we forget them, and that's one reason why I wanted to make sure every time you do a problem, you remember, is it including materials, labor, and overhead? Direct materials are materials that can be directly traced to the finished product. And I started with raw materials, although eventually the raw materials becomes work in process materials. But either way, you can trace them to the finished product. I've included eggs as a component in a manufacturing facility for cookies. You may not necessarily see the egg, but it is directly traced to the batter. So it is a direct material. All other costs, all other manufacturing costs, are considered manufacturing overhead. And just like there's three components in a product, direct materials, direct labor, and overhead, there's three components in manufacturing overhead: indirect materials, indirect labor, and other costs. Indirect materials are materials and supplies that can't be classified as direct materials. So for example, I've got a cooking spray. Depending on how hot the pans are or the ovens are, you may use more or less cooking spray. It's very difficult to measure, but it's a necessary item in order to complete the cooking process. It would be considered an indirect material. Indirect labor, the easiest way to explain that is it's labor that's not directly traced to the final product. And manufacturing supervisors, they're indirect labor. They are personnel who do not work directly on the products, but are involved in the manufacturing. There are also other costs. For example, other manufacturing costs are costs not easily traceable to the finished goods. You could have property taxes, insurance, depreciation, etc. So I've got the utilities here. Because a utility is used in manufacturing, you certainly have to pay your electricity and your heat, but you can't directly trace it to a product. So it's very easily a manufacturing overhead item. Now the interesting thing about categories is that some things mix into different categories. And this may not make sense why direct labor gets involved in two different categories, but it really helps management with their understanding of what to do about costs. So there are prime costs. Prime costs include direct material and direct labor, whereas conversion costs are the costs to convert the direct materials into finished goods and consist of direct labor and manufacturing overhead. But if you stop and break it apart, we never have prime cost plus conversion costs, so you're never adding the direct labor twice. You're just talking about what they do. The primary ingredients in a product are the material and labor. They're the primary things that go into it. You need the labor, otherwise if you're making cookies, the flour and the eggs just sit there. You need the labor to mix them. Now you could use the technology as well, but you need direct labor supervising, etc. And then when we talk about converting, if you're converting an egg into a final cookie, you're going to have the direct labor and manufacturing overhead. So that's why it's a conversion cost. Now, manufacturing costs are put in process and they're attached to a work in process inventory. The goods are completed, become finished goods, and then passed along to cost of goods sold when they're sold. But we need to calculate the cost of goods manufactured. This is the amount transferred from work in process inventory to finished goods when the goods are completed. I found that students always get things mixed up when they really do know better. The problem is students rely on the textbook, and the textbooks adapt the formula just to come out with the right bottom line. But you already know the cost of goods sold formula. So I suggest you fill it in, and your brain will do the algebra to get you to the right amount. So you know the beginning inventory plus what you purchased this period is goods available for sale. When you subtract ending inventory, you arrive at the cost of goods sold. So if you consider each manufacturing department as its own business, you know the cost of goods sent to the next department. Except we're not calling it cost of goods sold, we're calling it cost of goods manufactured instead. So keep your mind open to the actual meaning and plug in the missing numbers. This is the formula you're familiar with, and this is the formula that will help you solve a lot of the problems. So instead, if you think individually, we've got beginning inventory plus purchases. Well, what is the purchases? What did the department add? Well, the department paid for material, labor, and overhead, or the manufacturing process paid for material, labor, and overhead, depending how you cost each of your items. So beginning inventory plus those items we purchased says what's available, and my total manufacturing costs for the month are these items that I've purchased. When I add them to my beginning inventory, I've got the amount of work in process available. I subtract out my ending inventory, which is what wasn't finished, and I end up with what we'd call the cost of goods sold. But since we haven't sold them, we're just transferring them to the next department, we're going to call it the cost of goods manufactured. We just calculated the cost of goods manufactured, but we used material that had to be included in raw materials inventory earlier. When each inventory account computes the same amount as if it's its own business. So it was in raw materials inventory, but has now been transferred to work in process inventory. So raw materials department, the storeroom, is going to keep track of those items in the same process that we take care of everything else. So for raw materials, this is their cost of materials used, because they haven't manufactured anything. They've just used the direct materials as they transfer them out. And the amounts have to agree between the two departments. The amount we use for direct labor is easy. We just take it from the timesheets. Indirect labor is a much harder thing to trace, and we're going to cover that later in the course. Manufacturing overhead is a bunch of product costs that can't be traced to the individual product, and it includes indirect materials, indirect labor, and overhead. Now, the note here is that depreciation you might use is something on manufacturing equipment, and since it relates to manufacturing, it becomes a product cost. Another basic managerial accounting term you need to remember is cost drivers. A cost driver is any event or activity that causes cost to be incurred. They're basically direct labor or labor hours in a manual assembly work, machine hours if it's automated, and the higher the degree of correlation between the cost pool increase and the increase in its cost driver, the better the cost management information. Remember that certain costs have certain type of behavior patterns. So one of the categories or the classifications can be variable costs or fixed costs. The total variable cost moves in direct proportion to the change in activities. So for every movie you go to see, if you pay per movie, then the second movie, your total cost is twice as much as you paid for the first movie. Your total cost if you see 10 movies is 10 times the cost you paid for the first movie. That's the total variable cost. While the total variable cost changes, the variable cost per unit stays the same. So every time you go to the movies, you end up paying $7 a movie. Now you can argue that maybe somebody will give you a discount or something, but all of our costs are considered what we call the relevant range. So for our purposes of our analysis, the cost per unit will not change within that range. The total fixed cost remains constant in total as the level of activity changes. For example, you buy a movie pass. That movie pass costs the same whether you see 0 movies or you see 30 movies. The cost per movie, if you're dealing with a fixed cost, changes as the activity changes. So if you pay $150 for a movie pass and see one movie, the cost per movie is $150. If you happen to see 15 movies, the cost per movie is $15 a movie. If you see 30, the cost, $10 a movie. If you see 30 movies, the cost is $5 a movie. It never gets down to zero, even though it might get down to decimal cents, but the fixed cost per movie will never actually get down to a zero, and that's the reason there's a curve in the graph. We've talked about direct costs earlier when we talked about direct material and direct labor, but I'm trying to just give a little bit of a different example here, especially when things relate to period costs. So an entity to which a cost is assigned is going to be the cost object, and a direct cost is one that can be traced. We talked about this. So for example, flour for the cookie dough. But the indirect cost, one of those can be the payroll clerk. And the indirect cost might be part of the payroll clerk, which hits the manufacturing products, and it hits the sales and administrative, the things that we called regular period costs. So you really need to know what the cost is being used for. There's also controllable and uncontrollable costs. Controllable costs are things where the manager has influence, like direct materials. And uncontrollable costs are those which a manager has no influence. So a production manager can't control the CEO for the company's salary. So it's hard to evaluate someone based on costs of which they have no control. So when you're evaluating people and their decision-making capability, you want to take it apart. What could they control, what could they fix, and what could they not control? Controllable and uncontrollable costs. There's also opportunity costs. This is the benefit of choosing one course of action. You have the opportunity cost of the other course. Even if you made the better choice, you lost the opportunity for your first choice. So when you're making a decision, you need to look at the opportunity cost in each of the situations. That will help you make a better choice. Looking back at it, here's an example. College grads make $1 million more than non-grads. But the college grads give up the opportunity to make more money while they're in college. So it starts off as if the non-college grads are making more money than the college grads. But it might be a better choice to get your education first, because you get to the higher salary and you eventually get to that $1 million more than the non-grads. This opportunity is what you're giving up in this situation. Sunk costs are not relevant for decision making. They're costs that were incurred in the past and can't be changed by any future action. The cost you paid for existing inventory or existing equipment. These are also emotional costs because people put money into them. So a department that's already spent money on a new computer system will be reluctant to buy a better one because they feel like, well, we already spent all this money. But it's actually a sunk cost because it shouldn't be part of the future decision. It's also like paying for food that turns out to be awful and burnt, and management doesn't care and won't give you a refund or a discount. It doesn't make sense to eat the food that's burnt. And it's really unfortunate that we have to pay more and go somewhere else to a different restaurant. But the fact that we've already paid for the food that's burnt is a sunk cost. You also need to remember other types of costs. The differential cost is the net difference between two alternative courses of action, or of course 3 alternative courses of action, etc. The incremental cost is the increase in cost from one alternative to another. That's different from a marginal cost. That's the extra cost incurred when additional units are produced. And it's also different from the average cost per unit because you have to keep calculating this every time you add new alternatives and new costs in there. Accountants must weigh the benefits of providing information against the cost of generating, communicating, and using that information. The goal is to use all the information effectively, but we don't want to pay $20 to make a decision that's going to save us $10. So we have to be very careful of everything we're doing regarding our costs and our analysis of the costs. Everything we touched upon is also part of the service industry. So you still have controllable costs. You can still talk about direct costs. You still have marginal, you still have period cost and product cost. So you need to make sure that you're really understanding which costs are being used and what the categories are. There's also a bunch of decisions we haven't given specifics about. How do we break up the mixed costs into the fixed portion and the variable portion? We've got everything from regression to the high-low method. How do we choose between a make or buy decision? How do we choose between a special order? Those are all managerial accounting topics that you have in your first course. You need to remember them, but there's not room to really discuss them here. So that's the managerial accounting overview. Please let me know if you have any questions.